I am Max, and today I will guide you through 3 ETF portfolios built for different financial goals in 2026. Before we start, gently tap. Like if you want calm, reliable investment advice without hype or unnecessary stress. Also consider subscribing to this channel to never miss practical strategies that help you grow wealth steadily. Comment below where you're watching from and which portfolio type interests you most to start your investing journey. Many people search endlessly for the best ETF, but forget the real question is which strategy fits your future. The first step is understanding the environment. Inflation rose roughly 3% in the 12 months ending September 2025. Food prices also increased about 3% over the same period, gradually making saving and investing more challenging. The stock market fluctuates, with wild swings that make short-term volatility feel stressful but historically normal. For example, S&P 500 history shows strong growth years like 1933, 1995, and 2013, alongside declines in 1974, 2008, 2022. Understanding these cycles helps investors focus on long-term results instead of reacting emotionally to daily market changes. Think of your wealth as having 3 engines: income for cash flow, balanced for stability, growth for long-term expansion. The income engine generates steady cash so you won't need to sell shares during down years, reducing financial stress. The balanced engine cushions portfolio fluctuations while still allowing growth during positive market periods and recoveries. The growth engine pushes wealth ahead of inflation, fueling long-term accumulation without worrying about monthly payouts. By adjusting the strength of these 3 engines, you can tailor a portfolio to match your life goals and timeline. ETFs have become the favorite tool for everyday investors because they simplify diversification and reduce portfolio complexity. Instead of picking individual stocks, an ETF lets you invest in a group of companies with one single purchase. Imagine putting $1,000 into one tech company versus a tech ETF holding 100 companies. Risk is significantly lower. A single company dropping 40% hurts you deeply, but a diversified ETF might only slip a percent or two in value. ETFs also provide insight into returns through 3 components: dividend yield, dividend growth, and price appreciation over time. Dividends provide cash flow, dividend growth shows how quickly that cash increases, and price appreciation reflects long-term value gain. Another major advantage is automation. ETFs rebalance and update holdings, saving you time and preventing constant monitoring. Now the question becomes, which ETFs are actually worth owning for long-term, reliable wealth accumulation? Instead of drowning in charts and jargon, focus on 4 key metrics: quality, growth, stability, and income consistency. Quality ensures the companies inside ETFs have real earnings, healthy balance sheets, and survive both good and bad markets. Growth measures whether these companies are expanding revenue, profits, and industry dominance over time, boosting your ETF value. Stability reflects how well the ETF performs during market turbulence, helping you stay calm and avoid emotional decisions. Income evaluates dividends, cash payouts, and consistency, essential for surviving sideways markets and reducing stress while investing. By evaluating ETFs using these 4 lenses, you can identify which portfolios support your long-term financial goals effectively. Beginner investors often make mistakes, relying on instincts rather than structured strategies, which can lead to financial stress. Common errors include chasing hype, buying trending ETFs without fundamentals, and panic selling during normal market dips. Another mistake is overconcentration, putting too much money into a single stock or sector, increasing risk unnecessarily. Emotional reactions like checking portfolios every hour or trying to time market bounces often harm returns more than the market. Ignoring dividends, stability, and diversification while focusing only on short-term gains creates a fragile portfolio foundation. Recognizing these patterns early makes it easier to avoid mistakes and build a reliable, structured ETF portfolio. Let's start with the first portfolio, the income-focused setup, designed for steady cash flow and predictable returns over decades. This portfolio leans on stability and income, using 3 ETFs, JPI, SEHD, and BND, to balance growth and protection. JPI acts as the main income driver with an 8.26% dividend yield and a covered call strategy providing steady monthly payouts. Even defensively, JPI achieves a 5.49% dividend growth rate and 2.12% annual price appreciation over time. SCHD contributes durability and compounding, focusing on companies with solid earnings and balance sheets, providing 3.8% yield. SCHD's dividend growth rate reaches 10.43%, with long-term annual appreciation of 7.95%, enhancing portfolio compounding potential. BND adds stability through bond market exposure, offering a 3.8% yield and smoothing market volatility during downturns. Its long-term price return of 0.85% emphasizes protection rather than growth, helping investors stay invested without stress. Using a simple average, this income portfolio achieves a dividend yield of 5.29%, dividend growth of 6.5%, and 3.7% price appreciation. Let's illustrate real results. Investing $10 daily by year 1, John contributes $3,150 into this income-focused portfolio. After 10 years, the portfolio grows to roughly $370, demonstrating the power of disciplined, small daily contributions. After 20 years, the projection reaches about $237,440, with reinvested dividends contributing significantly to total growth. By year 30, total assets reach around $1,538,000, with approximately $747,615 coming from compounded dividends alone. Annual dividend income at year 30 is projected at $125,846, roughly $10,479 per month, all without selling any shares. This income portfolio highlights predictability and cash flow stability, ideal for investors prioritizing steady, stress-free returns. Next, we examine the balanced portfolio, designed for growth while maintaining stability during market fluctuations. This setup appeals to investors seeking higher long-term returns without the extreme volatility of a pure growth strategy. It combines stability, growth, and global diversification, providing a portfolio that feels steady yet rewarding during strong markets. SCHD forms the foundation, offering reliable dividends and smoothing volatility, keeping the portfolio grounded when markets get noisy. Its consistent dividend growth adds compounding strength without sacrificing safety, supporting long-term wealth accumulation. A Vanguard Information Technology ETF, or VGT, provides acceleration, capturing growth in cloud computing, semiconductors, software, and cybersecurity. VGT yields 4%, dividend growth of 10.11%, and annual price appreciation of 21.82%, driving substantial long-term portfolio expansion. INTF, the iShares International Equity Factor ETF, adds global diversification, reducing reliance on U.S. markets for steady growth. INTF provides a 2.67% dividend yield, 19.36% dividend growth, and 4.79% annual price appreciation, strengthening portfolio resilience. Together, SCHD, VGT, and INTF balance safety, acceleration, and diversification for a portfolio positioned between income and growth. Using simple averaging, this balanced portfolio achieves a 2.29% dividend yield, 13.3% dividend growth, and 11.52% annual price appreciation. Imagine John investing $10 daily into this portfolio, contributing $3,750 by the end of year 1, starting his long-term plan. After 10 years, the portfolio is projected to grow to approximately $70,821, illustrating steady wealth accumulation over time. By year 20, total assets are expected to reach $346,384, combining capital appreciation with reinvested dividends efficiently. At year 30, the projection shows around $1,292,394 in total value, with roughly $318.99 started from reinvested dividends alone. Annual dividend income at year 30 is projected at $48,973, roughly $4,081 per month, a meaningful cash flow without selling shares. Compared to the income portfolio, the balanced portfolio delivers more total value and still provides reliable monthly income. The combination of stability, growth, and global exposure makes it ideal for investors seeking moderate risk with meaningful long-term returns. Now, let's move on to the growth portfolio, built exclusively for maximum long-term wealth creation with high compounding potential. This portfolio targets investors who can tolerate short-term volatility in exchange for potentially massive wealth over decades. Monthly dividend payouts are minimal, as the focus is on multiplying capital through ownership of innovative, high-growth companies. VGT is the main growth engine, focusing on technology and innovation sectors that drive future economic expansion. Its high compounding potential comes from long-term price appreciation, with dividend income secondary in importance. Invesco QQQ ETF adds acceleration, tracking leading tech, biotech, communication, and consumer innovation companies with strong growth records. QQQ provides a 46% yield, 9.45% dividend growth, and 17.12% annual price appreciation, outperforming broad market indexes historically. IWF, the iShares Russell 1000 Growth ETF, broadens exposure beyond technology, including finance, healthcare, retail, and industrial sectors. IWF reduces overconcentration risk, while keeping the portfolio focused on long-term growth opportunities across multiple industries. Together, VGT, QQQ, and IWF create a growth-focused portfolio with an average dividend yield of 4%, 7.2% dividend growth, and 18.46% appreciation. Investing $10 daily, John's growth portfolio reaches roughly $80 to $120 after 10 years, demonstrating strong compounding early in the plan. By year 20, the portfolio grows to about $574,690, showing the power of long-term investment in high-growth ETFs. At year 30, total assets are projected at $3,118,560, with capital appreciation driving nearly the entire increase. Dividend income is only about $339 annually, or roughly $28 per month, highlighting the focus on growth rather than immediate cash flow. This strategy emphasizes patience and long-term compounding, suitable for investors prioritizing wealth maximization over monthly income. Compared to income and balanced portfolios, the growth portfolio generates millions more in total value over 30 years. The trade-off is minimal dividend income, but long-term capital gains more than compensate for most investors' wealth goals. Selecting the right ETF for your goals ensures alignment with your financial plan and reduces the temptation to react emotionally to markets. Diversification across sectors and geographies is essential to manage risk while allowing exposure to high-growth opportunities. Small daily contributions, like $10, compounded over decades, illustrate the extraordinary potential of disciplined, consistent investing. Reinvested dividends play a key role in income and balanced portfolios, while capital appreciation dominates in growth-focused strategies. Understanding each ETF's role in your portfolio helps you adjust allocation according to your risk tolerance and future needs. Whether you prefer income, balanced, or growth, all three portfolios leverage the same core principles of quality, growth, stability, and income. ETFs make complex investing simple, allowing everyday investors to achieve diversified portfolios without extensive stock-picking expertise. Recognizing mistakes like overconcentration, panic selling, or chasing hype early prevents emotional decision-making and portfolio damage. The three engines, income, balanced, growth, allow you to tailor your portfolio for your desired financial lifestyle and timeline. With discipline, automation, and proper allocation, even modest daily contributions can build wealth that surpasses most expectations. Monitoring your portfolio occasionally is sufficient. ETFs rebalance automatically, keeping your investments aligned with long-term goals. By understanding market cycles, you remain calm during pullbacks, seeing declines as natural parts of the long-term growth process. Structured ETF portfolios provide a reliable framework to avoid common mistakes and optimize wealth accumulation over decades. Selecting ETFs through quality, growth, stability, and income ensures long-term resilience, minimizing stress and maximizing potential returns. Ultimately, choosing the portfolio that matches your life plan, risk tolerance, and goals is the most important decision you will make in investing. Now, let's summarize the key differences between the income, balanced, and growth ETF portfolios for clarity. The income portfolio prioritizes monthly cash flow, stability, and minimal stress, ideal for conservative, predictable investors. Balanced portfolio combines income, growth, and global diversification, offering moderate risk with meaningful long-term rewards. Growth portfolio emphasizes long-term capital appreciation, accepting high short-term volatility for potentially massive future wealth. Comparing projections, growth portfolio outperforms balanced by roughly $1.73 million and income portfolio by over $216 million. Dividend income differs. Income portfolio delivers 10,079 month, balanced 4,081 month, while growth portfolio provides only 28 month. Each portfolio is structured using the same principles: quality, growth, stability, and income. But weightings vary by goal. Choosing the right mix ensures your investments align with life goals, time horizon, and personal risk tolerance. The disciplined approach, even with small contributions like $5, $10 daily, shows the extraordinary power of compounding over decades. Reinvested dividends amplify wealth and income and balanced portfolios, while capital appreciation drives growth portfolio results. Automation through ETFs eliminates the need for constant monitoring, allowing investors to focus on life while wealth grows steadily. Understanding market cycles prepares you for volatility, making drops feel normal rather than threatening to your long-term plan. Avoiding common mistakes like overconcentration, hype chasing, or panic selling protects your portfolio and maximizes outcomes. Allocating across multiple sectors and geographies mitigates risk and ensures a balanced exposure to global growth opportunities. Max here reminds you that consistency matters more than timing. Regular, disciplined contributions beat attempting to time the market. Structuring your portfolio with clear engines, income, balanced, and growth simplifies decision-making and reinforces long-term strategy. Even modest investments accumulate substantial wealth over decades due to the combined effect of compounding and reinvestment. The income portfolio demonstrates stability and predictable monthly dividends, perfect for supplementing salary or covering living expenses. The balanced portfolio delivers a blend of stability and growth, providing both meaningful dividends and long-term capital appreciation. The growth portfolio focuses purely on long-term wealth, ideal for those willing to endure volatility for massive capital gains. Understanding each ETF's contribution allows you to tweak allocations based on changing market conditions or personal circumstances. For example, increasing growth exposure accelerates capital appreciation while reducing dividend income, and vice versa for income-focused goals. By structuring portfolios properly, investors avoid the trap of random ETF selection and achieve consistent, reliable results. Diversification across sectors like technology, healthcare, finance, and international markets reduces risk while enhancing potential growth. Max emphasizes that time in the market, not timing the market, is the most critical factor for long-term wealth creation. Discipline in contributions, reinvestment of dividends, and patience with market cycles drives compounding power to its maximum potential. Even a $10 daily contribution consistently applied can grow into hundreds of thousands or millions over 30 years. Investors often underestimate how small, consistent actions accumulate into extraordinary results when compounded over decades. Avoiding emotional reactions to daily market fluctuations ensures decisions are strategic, not impulsive or stressful. ETFs simplify complex investing by offering instant diversification, professional management, and automated rebalancing. Income, balanced, and growth portfolios all leverage the same ETFs differently, demonstrating flexibility based on personal goals. Max advises tracking your portfolio occasionally, but trusting the structure and automation prevents overreacting to short-term swings. The income portfolio is best for investors seeking security, predictable cash flow, and compounding without anxiety over market drops. Balanced portfolio fits those seeking moderate growth with global diversification, still enjoying steady dividends without extreme risk. Growth portfolio suits aggressive investors aiming for maximum long-term wealth, focusing on innovation-driven sectors and capital gains. Comparing all three, investors see trade-offs between cash flow, stability, and maximum capital appreciation over decades. Max highlights that choosing a portfolio is personal. It should match your financial timeline, lifestyle, and risk comfort. Even small adjustments, like shifting from balance to growth slightly, can meaningfully impact 20 to 30-year projections. Consistency and patience remain more powerful than attempting to chase trends or time markets perfectly. Diversification remains essential, spreading risk across sectors, companies, and geographies to protect against unexpected downturns. Reinvesting dividends accelerates wealth accumulation, particularly in income and balanced portfolios, amplifying the effects of compounding. Capital appreciation dominates the growth portfolio, highlighting that wealth building does not always require high monthly cash flow. Max reminds viewers to avoid common pitfalls: emotional decisions, overconcentration, chasing hype, and ignoring fundamental quality. ETFs provide clarity by packaging multiple companies into a single investment, reducing risk, and easing portfolio management. Using quality, growth, stability, and income as filters ensures chosen ETFs align with long-term financial goals. Balanced portfolios combine these metrics to achieve moderate risk, sustainable growth, and meaningful dividends simultaneously. Growth portfolios leverage high-growth companies for maximum compounding, sacrificing monthly income for long-term wealth accumulation. Income portfolios emphasize stability and predictable dividends, providing safety and reliable cash flow for everyday needs. Max emphasizes the power of starting early, even with small daily contributions, to maximize long-term wealth potential. Small, consistent investments grow disproportionately over decades due to the exponential nature of compounding and reinvested dividends. By year 30, income portfolios can generate $10,000 per month in dividends without selling a single share, illustrating predictable cash flow. Balanced portfolios combine dividends and growth to reach nearly $1.48 million, offering meaningful income and capital appreciation simultaneously. Growth portfolios, while low on dividends, can compound to over $3 million in total value through patient long-term investing. Each portfolio demonstrates different trade-offs between cash flow, risk, and potential long-term wealth, suited to different investor goals. Diversification remains a cornerstone, spreading investments across sectors, geographies, and asset types to reduce overall portfolio risk. Max advises measuring your personal risk tolerance before selecting a portfolio, aligning investments with lifestyle and financial goals. Even minor tweaks like adjusting ETF weighting slightly can significantly impact long-term projections over 20-30 years. Structured ETF portfolios reduce stress, minimize errors, and provide a roadmap for consistent wealth building over decades. Max reminds viewers that patience is critical. Market volatility is normal, but long-term trends favor disciplined investors. Avoid reacting to short-term fluctuations, focusing instead on long-term compounding and consistent contributions to build wealth. Income-focused ETFs provide predictability, while balanced and growth portfolios allow varying levels of risk and potential reward. Max emphasizes the importance of using reliable sources for updated data, ensuring investment decisions are informed and evidence-based. Tracking portfolio performance occasionally ensures alignment with goals, without succumbing to daily market distractions or panic decisions. Dividend reinvestment accelerates compounding, increasing total returns over decades without additional investment beyond your daily contributions. Understanding the mechanics of each ETF allows you to adjust strategies as personal or market conditions change over time. Growth ETFs focus on innovation-driven sectors, capturing long-term trends in technology, healthcare, and global market leaders. Balanced ETFs blend income and growth for moderate investors seeking a mix of stability, dividends, and long-term capital gains. Income ETFs emphasize high, reliable dividends, prioritizing consistent cash flow and capital preservation over aggressive growth. Using these frameworks, investors can design portfolios tailored to their personal financial roadmap and long-term objectives. Max encourages starting immediately, even small daily investments, to leverage the exponential benefits of long-term compounding. ETFs automate diversification, rebalancing, and holdings updates, making portfolio management simpler and less stressful for everyday investors. Consistency in contributions and reinvestment ensures steady growth, regardless of market turbulence or economic uncertainties. Max highlights the importance of understanding historical market patterns, helping investors remain calm during downturns. Diversified portfolios reduce emotional risk and minimize losses during corrections, ensuring investors stay invested for long-term growth. Capital appreciation, dividends, and dividend growth together form a powerful combination, creating predictable and sustainable wealth over decades. Each portfolio type suits different priorities: income for stability, balanced for moderate growth, growth for maximal long-term returns. Max reminds viewers that wealth is built slowly, with discipline, time, and proper allocation rather than overnight speculation. Small daily contributions, even $5 to $10, when invested consistently, can result in extraordinary financial outcomes over 30 years. Avoid impulsive trading, chasing trends, or overconcentration. These behaviors are major causes of long-term portfolio underperformance. ETFs simplify investing, enabling everyday investors to access diversified, professionally managed portfolios without extensive expertise. The income portfolio excels at delivering reliable dividends, ideal for supplementing income or covering monthly living expenses. The balanced portfolio achieves moderate growth, combining steady dividends with appreciation, providing a versatile long-term solution. The growth portfolio maximizes capital gains, focusing on high-growth sectors and is suitable for patient, risk-tolerant investors. Max emphasizes reviewing goals periodically, ensuring portfolio alignment with evolving financial needs and life milestones. Even minor adjustments in allocation can meaningfully impact long-term projections, highlighting the importance of strategic planning. Patience, discipline, and regular contributions remain more impactful than attempting to time the market or chase short-term gains. Diversification, automation, and a structured approach reduce stress and enhance long-term wealth accumulation across all portfolio types. Max advises focusing on quality ETFs that demonstrate growth, stability, and reliable income. Understanding each ETF's role within a portfolio clarifies how different engines, income, balanced, growth, drive results. Capitalizing on market cycles and compounding allows even small daily investments to grow into significant wealth over decades. Reinvested dividends combined with disciplined contributions multiply returns in income and balanced portfolios, amplifying total value. Growth ETFs emphasize innovation-driven companies, leveraging sectors like technology, healthcare, and consumer services for long-term appreciation. Balanced portfolios combine stability and growth, offering meaningful dividends while still achieving substantial long-term gains. Income portfolios focus on stability and predictable cash flow, reducing stress and providing consistent monthly income. Max reiterates the importance of choosing a portfolio aligned with personal goals, risk tolerance, and life timeline. Small, consistent actions compounded over decades produce extraordinary results, demonstrating the power of disciplined investing. ETFs provide diversification, automation, and simplified management, making them ideal for everyday investors seeking long-term wealth. Max concludes, understand your goals, choose the right portfolio, stay disciplined, and let time and compounding do the work. Comment below which portfolio fits your life plan, share this video, and subscribe to continue learning practical investing strategies. And finally, if you want to see how $5 Daily can generate over $8,000 monthly in dividends, click the next video now.